Hello, everybody. JD here with your Rational Trader Market Analysis Daily. In today's video, using expected value analysis in your decision making for your particular trading, whatever strategy you're following. So, this past weekend, I was really thinking quite a bit about statistics. And one of my favorite uh, I guess, areas of statistics was this concept of expected value. And without getting into the weeds on expected value, the general idea is that in a given uncertain event with various probabilities and different outcomes and assigning values to those outcomes, you can take the probabilities that a certain outcome will occur and determine whether or not you should take that particular action or not. Now, in most trading situations, you don't have the ability to assign probabilities to the multiple various outcomes that can occur in the stock market. But that isn't necessarily true during earnings season, which is quickly becoming my favorite time to uh, place what I call mean reversion cash machine trades on companies that are reporting earnings and utilizing call writing, call buying, put writing, whatever the case may be. It really just depends. So let's start with a very simple question. Uh, Two trades with two different outcomes. One trade is going to be a loser, whereby you lose $4.45 per contract. And let's just assume it's one contract. So, this particular trade, you have the outcome of either losing $445 or you have the opportunity to make 55 cents or $55. You can lose, again, I'll say it again, you can lose $445 on the trade, or you can make $55 on the trade. Which, well, those are the two outcomes. The question is, are you going to make that trade? And I think the knee jerk reaction for most people would be to say, hell no, I'm not going to make that trade. I'm going to preserve my capital. I don't want to take a risk of losing $4.45 on the trade. Now, there's a big piece of data that's missing. What are the probabilities of each of those outcomes occurring? And if I told you that you have a 90% probability of making the $55 on the trade versus only a 10% probability of losing $445 on the trade. Now, which would you make that trade? Okay, that's a little bit different. 10% probability of the big loss versus 90% probability of the small gain. When you put it all together and do the math on the trade, the answer is a positive expected value, meaning you should make that trade no matter what. Now, let's put this into uh, action with a real potential trade that we can make tomorrow on a company, Constellation Brands, earnings season. Constellation Brands reports earnings tomorrow after the market closes. Now, in advance of that earnings report, Constellation Brands trades below below the mean price of $166.86 a share and above two standard deviations below the mean of $155 a share. So I believe, generally speaking, that the magnetism of the mean price is very, very powerful during earnings season. So if I'm looking at this trade, again, without looking at any historical perspective of how Constellation Brands trades after its earnings report, I immediately am attracted to the put side with the two standard deviations being the floor, and I can write a put below that floor at $150, and I can collect, as of today's close, I can collect 80 cents on that trade. Okay, so again, this is a little bit complicated, but I want to walk you through this because it's really powerful. Now, not only can I write that premium and collect 80 cents on a put contract, I can limit my loss to $5 less the premium that I collect, in this case, 80 cents, and buy a $145 strike put. By the way, these contracts expire on July 3rd, so the time decay is going to be fierce after earnings. So we're not going to have to really worry about that. We can really focus in on what happens after this company reports results. And that's what is really important. If I told you that, and by the way, the mean price or two standard deviations below the mean is at current levels approximately 4.25% lower than where the stock closed today at $162 a share. A $150 put or $150 strike price put is almost 8% lower than the current price, and the 145 strike put is almost 11%. Now, over the last 5 years, Constellation Brands has only traded greater than 8% lower two times, twice. So 20 events, 2 out of 20, or 10%. So you get why I was using that 10% outcome on a defined loss credit spread. Okay, this trade that I just gave you is a credit spread. You are going to have a defined loss of $5 less the premium collected less the price paid for the option. So that's 50 cents right now. It used to be 55 cents, but it closed at 50 cents. All right. Now, there's a 90% probability based on the last 5 years of Constellation Brands trading below 100, the 150 strike, right? Which is 8% lower than the current price. That's only happened twice, 2 out of 20 times. Okay. And so for the more aggressive trader, you could, without, I mean, this is a big, obviously, greatly increases your risk, but you could just write the 150 put and collect 80 cents. And, you know, again, Constellation Brands, out of 20 earnings reports, was down 8% or more twice. All right. It just doesn't happen very often. It is more likely that the stock is going to trade higher, or if it does go down by, I believe the mean, let me just look real quick. The median negative move is minus 3.3%. So if you use the median decline on this trade, you are only at, well, you're above two standard deviations. You're somewhere between $155 a share, I'm sorry, $156 a share and $160 a share. Okay. So that's the median outcome on the downside when Constellation Brands reports results. So Constellation reports tomorrow after the market closes. You'll be able to watch this in real time, but I really encourage you to incorporate expected value when you're making go or no go decisions on your trading. That's all I have for today's video. This is JD. I'll be back tomorrow with another video. Take care, have a great day, and we'll see you all next time.